Welcome to the Self-Taxers YouTube channel. If you're an expat, business owner, or landlord and you're not subscribed yet, this channel is for you. We break down tax rules, deadlines, and changes, clearly and simply. Hit subscribe and stay compliant, without the stress. Capital gains tax is about to catch far more people than most expect. If you own property, shares, or crypto, 2026 could be the year your tax bill jumps, even if your profit hasn't changed. Meet Hannah. She bought a rental property years ago, looked after it, and watched its value rise. Now she's thinking about selling. But when she checked her capital gains tax position for 2026, the numbers didn't look right. Not because she did anything wrong, but because the rules have changed. Allowances are smaller. More gains are taxable. And HMRC is watching disposals more closely than ever. In this video, I'll explain exactly what's changing in 2026, who will be affected most, and what you need to prepare before you sell any asset. Hannah has done everything right. She bought her rental property years ago, kept it well maintained, and rented it out properly. Over time, the value increased, just as she hoped it would. Now, in 2026, she's ready to sell and move on. The profit looks the same. The plan hasn't changed. But when Hannah checked her capital gains tax position, she got a shock. Her estimated tax bill was much higher than she expected. Not because the property performed better. Not because she made a mistake. But because the rules around capital gains tax have changed. The allowance is smaller than it used to be. And that single change is pulling more people, like Hannah, into paying CGT for the first time. Let's look at the numbers, clearly and accurately. Not long ago, capital gains tax allowance was £12,300. That meant a large part of many gains was completely tax-free. Then it was cut to £6,000. And then cut again to just £3,000. In 2026, that allowance stays at £3,000. That means only the first £3,000 of profit is tax-free. Everything above that is now taxable. So if you sell a property, shares, crypto, or another valuable asset and your gain exceeds £3,000, capital gains tax applies. The key point is this. Many people's profits haven't increased, but their tax bills have. Because the allowance is smaller, more of each gain is pulled into the tax system. Now, who feels this change the most? There are three main groups. First, landlords selling rental properties. Property gains are often large, built up over many years. With such a small allowance, a much bigger share of the profit is now taxable. Second, investors selling shares or funds. You do not need a huge portfolio to cross the £3,000 limit. Even modest investment gains can now trigger capital gains tax. Third, crypto traders. Every disposal counts. Selling, swapping, or using crypto is a taxable event, even if the money never hits your bank. Hannah falls into the first group. She owned her rental property for 8 years. Its value rose steadily over time. Under the old allowance, more of that gain would have been tax-free. In 2026, much more of her profit falls into taxable territory, increasing her CGT bill. Let's clarify the capital gains tax rates that apply in 2026. If you sell residential property, the basic rate is 18%, and the higher rate is 24%. These rates were reduced from 28% in 2024 and remain unchanged in 2026. For shares, crypto, and other assets, the basic rate is 10%, and the higher rate is 20%. Your rate depends on your income tax band. If your income plus your gain pushes you into the higher band, the higher CGT rate applies. Here is the part many people do not realize. HMRC monitoring of capital gains tax is far stronger in 2026. When a property is sold, estate agents and solicitors report the transaction. Investment platforms share disposal data directly with HMRC. Crypto exchanges now follow strict reporting rules and submit activity records. Banks also flag unusually large deposits that may represent capital gains. This means gains are harder to miss and harder to hide. In Hannah's case, HMRC already knows her property was sold before she even starts her tax return. Let's walk through Hannah's numbers step by step. First, take the sale price and subtract the original purchase price. That gives the initial gain. Next, subtract allowable costs: stamp duty, legal fees, and qualifying improvement work. Then, apply the £3,000 capital gains tax allowance. Finally, apply the correct tax rate based on income. Hannah is a higher rate taxpayer, so she pays 24% on her property gain. If she had sold years earlier, her bill would have been lower. The smaller allowance in 2026 makes the difference. Before you sell any property, shares, or crypto in 2026, prepare properly. Estimate your gain before you sell. If it exceeds £3,000, expect capital gains tax. Keep every receipt and improvement record, especially for property. These reduce your taxable gain. Check your income position. Your income band directly affects your CGT rate. Report property sales within 60 days. Missing the deadline triggers automatic penalties. Plan disposals carefully. Multiple gains in one tax year can add up fast. Capital gains tax is one of the most misunderstood parts of the UK tax system. In 2026, the rules are tighter. The allowance is smaller, and HMRC oversight is stronger than ever. Whether you are a landlord, an investor, or a crypto trader, preparation matters before you sell. Like Hannah, the key is knowledge. When you understand the rules, you stay compliant and avoid unnecessary tax bills. For clear, accurate UK tax guidance, without confusion, subscribe for the next episode. Self-Assessment 2024-25, check, file, and stay ahead. Thanks for watching. If you found this helpful, subscribe selftax.co.uk for more clear, practical UK tax guidance.